what most people are lacking is the nuance with this. You're going to hear people on different sides that agree, but you're going to think they disagree because you don't understand the nuance in there. And it's important to understand the nuance because that's where we make the money. That's where we find our edges, in the nuance here. Now, the first thing I want to say just to set this up, and I'm going to show you examples of this, is that there is no such thing as the real estate market. There's no such thing as that. There's thousands of real estate markets, thousands and tens of thousands of markets broken down by property type and size and all different factors, all different areas, all right? So there's no such thing as there's thousands of markets, and each of these factors will affect them differently, but let's go ahead and jump in. So the first thing, is the market going to crash? Well, I'm going to show you the data to show you this, but we do know that housing is in decline right now. We know that, okay? So we have facts on that. What we can see is that housing starts. So these are permits that are being pulled to build new houses. This is a leading indicator. If you're not pulling permits, then you're not building houses. If you're not building houses, there's no new houses being sold. That's pretty apparent, right? So we can see that residential starts declined by 14% last month. It's not a small decline, 14%. That is the lowest in more than 1 year. You can see this kind of highlighted here, a little bit of a decline right here. You can see this decline right here. Now, let's put this into perspective. Now, I'm going to show you different charts, so hold with me here. But you can see we're all the way down here, which is still at a pretty high level compared to the last couple of years. Here, we've dropped all the way to here, but we're still at a pretty high level. Now, as I tell you all the time, the reason why I like to show you the charts is it's not just the size of the move. We want to see the direction. We also want to see the speed in which that move is happening. So 14%, okay, housing is declined, not necessarily a good thing to look at. Let's keep that in mind. Okay, what else do we see? We can see that prices are dropping. This is shares of Redfin and Zillow, so this is their stock. Doesn't really mean a whole lot, but the prices of those are coming down. No big deal. All the tech stocks are coming down, so we shouldn't even really be looking at that, but I'm just trying to show you all of this data. Now, back to the housing starts that have declined, I want to give you a little bit of a bigger perspective. So this is going back all the way to 1960. So we have over 50 years of data, and so what we can see is the housing starts are coming down. They are, for sure. But this red line is about the average of where housing starts would be. And you can see we are nowhere near the average housing starts. We are still pretty high. And so, yes, they're coming down, but does that mean we're going to crash? Are we below average? And the answer is certainly not. We can see here that this is a forecast. This is from Fortune magazine, and they're projecting U.S. home price growth. You see year over year from 2018, and the price of homes have gone up pretty steep. And now they're forecasting, this is Fannie Mae, so this is the government. Fannie Mae's forecast for 2022 is a 10% increase in home prices, and for 2023 is a 3% increase in home prices. So the change, this is like CPI. The change is going down, but it's still forecasting for home prices to be going up, just at a much slower pace. Now, again, we are seeing stuff soften, all right? So, like, I'm being real. We're going to look at both sides of the argument here so you can get the best information that you need. And we can see during the 4 weeks that ended June 5th, 16% of listings in LA County had been price cut to 7.5%. And what happens is when the market's going up, every new house is priced higher and higher and higher. And they're pricing, as we saw that exponential growth, so they're pricing higher and higher and higher. And eventually, as we showed you per Fannie Mae, instead of going up by 20% a year, they only go up by 10%. So people had priced their home 20% higher to get that 20% growth rate, but then it's not going to go up by 20%, it's going to go by 10% or even 3%. So they priced it 20% over market, and now they just have to price it 3% over market. Doesn't mean prices are going to crash, they're just marking their houses down to adjust for a more moderate increase. All right, well, let's look at some more data. Prices are in a bubble. All prices are in a bubble. Everything is always in a bubble. What stage of the bubble could be a better question. So is it a bubble like this? Is it a bubble like this? Or is it a bubble like this? So everything's always in a bubble, of course, but let's take a look at this. So there's the Case-Shiller index, and this is what everybody references. My good buddy George pulls this up on his real estate videos and shows you the Case-Shiller index. We're going to look at that a little bit later. I'm going to tell you why the Case-Shiller is a bad index to look at, and I'm going to show you some adjusted numbers. But for now, this is the Case-Shiller index for the housing. We can see going back to 1987, we can see this big bubble here in 2008. And per this, it looks like we are much higher, and we are. The data shows that clearly. We are much higher than we were in 2008. However, is this the right data to look at? Well, we need to adjust it to get some real numbers, which we'll do that in a minute, but this is what the Case-Shiller shows us. All right, but there's other factors to think of. What we can see is, as I've already said, real estate has been going up astronomically. I showed you the chart. U.S. home prices rise at the fastest pace in 15 years. Case-Shiller index increased 11%. All right, so that's going up really, really fast. We know that. But I want to show you a couple charts, and then we're going to dig in a little bit. But this is per the Federal Reserve data, Fred data, and we can see back to Case-Shiller. So here's 2008, here's today. You can see that we have gone up. We've gone up by 60%. So home prices are 60% higher today than they were nationally on average, are up 60% higher than they were in 2008. But there's one thing, I'm going to give you a hint, and we're going to come back to this, but this is the Fred M2 money supply. So you heard that about 40% of all money in existence today was created in the last 2 years. So they create a bunch more money, which makes your dollars purchase less and less. So if you're only measuring in US dollars, you have to understand that the US dollars are manipulated, and so you have to adjust for that. So what we can see since 2008, look how many dollars have been created. Yeah, so you need to adjust home prices based off of the growth of the money supply. So we're going to take a look at that. Now, a couple other things before we dig deep into this data I want to show you. So we can see since January of 2000, so in the last 22 years, average home prices have gone up by 100%. So they've about doubled in 22 years. Okay, so that's something to keep in mind. But remember, there's no such thing as the real estate market. There's thousands of markets. So this gives us a little bit of example. So this is the biggest home equity gainers by city of the top 10 metro areas over the last decade. Okay, for the last decade. Now, what we can see is we have 3 areas that are circled in red. All 3 of those areas are the same area. We have San Francisco, San Jose, and Oakland. Those are basically 3 of the same cities. Now, any reason why those 3 cities may have been the fastest growing in the nation over the last decade? Silicon Valley, yeah, that's where Silicon Valley is located. So think supply and demand. So when you have Silicon Valley and everybody's making billions of dollars and they're attracting the best talent and the average pay is going up and everybody needs to live there, there's not a lot of houses there, what happens to those prices, supply and demand? People are making hundreds of millions of dollars. Probably salaries are 10, 20, 30 million dollars. What do they care if a house is 1 or 2 million? And so Silicon Valley has been the highest area in the nation. We had 92%, 98%, and 92%, where down here, Washington, D.C. went up by only 27%. Supply and demand. There's thousands of markets broken down by all different types of factors. So I just kind of wanted to show you that before we keep going in the data so you can look at some of this nuance that's here. All right, now let's look at the last housing crash, which was 2008, and let's compare that to now to 2022. All right, now, first of all, all right, I'll save that. So 2008 versus 2022, or let's say 2008 crash 2.0. So first thing to understand is that the 2008 great financial crash was a housing crash. So just like the 2000 market crash was the dot-com crash, that was the blow up of the dot-com boom, 2008 was the housing market crash. That's what it was specifically. Does that mean the next crash will be a housing crash, or will it be a tech stock crash? Or will it be a student loan crash, or a used car bubble crash? So let's take a look at that. So what was different? So in 2008, we had a big problem that mortgage-backed securities became over-leveraged. And so we had this massive market where the government were buying these mortgage-backed securities. They were bundling all these mortgage-backed securities into sausage, selling these all off in securities, and it became a massive, massive problem. There was a movie made about it called The Big Short. Highly recommended if you haven't watched it. It kind of breaks it down pretty good. But you can see the cause of 2008 great financial crash caused by deregulation in the financial industry that allowed the Wall Street to go ham crazy and do all these sausages with these mortgage-backed securities, blending them together so nobody knew what the risk was and selling them off and rehypothecating them and making a bunch of money. And then it made the appetite massive for this, and so they started giving mortgages to anybody. We'll talk about that. It permitted banks to engage in hedge fund trading, so now they got super risky with these mortgages. The banks demanded more mortgages. We want more money. We'll do anything. We'll give a loan to anybody. We don't even care if you have a heartbeat. We're still going to give you a loan, and it created interest-only loans affordable to what's called subprime borrowers. We got a little bit more right here. The Federal Reserve decreased interest rates from 6.5 to 1%. And so the banks could get money for basically free from the Federal Reserve, and they could make that whole spread. They had never made so much money. They would give it to everyone. Everyone starts to take out mortgages. People with low income and poor credit were accepted to these loans because Wall Street wanted these things. They wanted these mortgage-backed securities. They wanted to trade them off. Supply of housing goes through the roof. As mortgage demand skyrockets, risky mortgages and the production of too many houses led to the demand decreasing as a result. So then there was so much demand, people were going and buying 5 houses, 10 houses in a new subdivision. They would stand in line to get their name placed to buy 5 houses. Who's going to live in those 5 houses? And so then construction was overbuilt, all these things happened. And then people owned, we'll skip that part. Okay, so you have to understand it was a lot different. What happened was then we had overbuilt. We had 9 worst recession ghost towns. So then throughout California where I'm at, through Phoenix, Las Vegas, also in Florida, you had entire towns that were built that nobody even lived there. Ghost towns, kind of like what happens in China. So we had way overbuilt. We had all these houses, all these construction companies. Nobody needed it. Nobody lived there. They were ghost cities. So we had everybody in the world, even without a pulse, had a mortgage or had 5 mortgages in a lot of cases. They had them all on adjustable rate mortgages that were very low. Wall Street packaged all these things up and created all these derivative products off of them and created this giant mess. And we had this oversupply of houses, nobody could even buy them anymore. We were stuffed to the gills. So you have to understand the situation was a lot different. And of course, when it crashed, it was also a lot different. We can see the average decline across the United States was 33%, but it was different in different states. So in California, the average drop was 42%. Where I'm located in Southern California, it dropped 60%. Florida dropped 50%, Arizona dropped 51% on average, but some of these states barely dropped at all. Nebraska, 5%, Oklahoma, 6%. The reason why I'm showing this to you is there's no such thing as the real estate market. You're asking me, Mark, should I sell my house? Should I buy a house? Where do you live? That's the first question. If you lived, even in the worst great financial crash, the real estate crash, if you lived in Arizona, on average, you lost 50%. That was tough. But if you lived in North Dakota or Nebraska, you lost 5%.